Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke, and today we're going to answer some of the Ask James questions of the day. We have this question from Jake. Jake says, I'm getting 5% in CDs and short-term treasuries. I'm not retiring just yet, but overall, I feel pretty good, and I feel like I'm prepared. So what am I missing? Well, it sounds like Jake here has taken a prudent, conservative approach in preparing for retirement by investing in CDs and short-term treasuries, earning around 5%. With limited risk exposure, that cash flow provides a nice income baseline as he looks towards transitioning into retirement soon. However, you raise an excellent point about what potential pitfalls or blind spots Jake may be overlooking with this strategy. While the 5% yield seems attractive today, we have to consider the future interest rate environment and sustainability of those yields over a very long retirement time horizon. The reality is, for much of the last 15 years, interest rates have been historically low following the Great Recession. So a 5% yield on relatively risk-free investments was extremely difficult to come by in that context. But Jake's current portfolio income stream would have seemed extraordinarily high just a few years ago. But now, with the Federal Reserve actively raising rates to combat inflation, we find ourselves in a rising rate environment where that 5% may not seem so lucrative, a few years from now. So as those CDs and treasuries mature, Jake will be reinvesting that money at the kind of then prevailing rates. And that could potentially be lower. So right now, Chairman Powell has clearly signaled the Fed's intent to tackle inflation as the priority, even at the potential cost of allowing a recession. So while rates may stay elevated for the near term, there are no guarantees they return or that they will remain at current levels throughout Jake's 20 to 30 year retirement. The danger Jake faces by staying over allocated to short-term kind of rolling investments is that his income streams could get squeezed significantly, if and when rates eventually decline, again, from these kind of cyclical highs. His 5% income today could dwindle to 3 to 4% or even lower, which drastically impacts the sustainability of his retirement lifestyle. One potential solution, as Jake is nearing retirement, is to take advantage of currently higher rates to help lock in income for longer through investments like bond ladders or potentially out 10 plus years, right? Yes, he may need to account a somewhat lower yield today, but he gains income certainty for an extended period. He could also explore adding some growth components back into his portfolio through dividend stocks, REITs, or other income-producing assets that have opportunity for rising income streams over time. This provides a hedge against any future falling interest rate environments. The key is creating a truly diversified income floor using a mix of different investments and duration profiles. This way, Jake isn't overly exposed to any one interest rate risk. Ultimately, being able to sustain his desired retirement lifestyles is the end goal. With a little more income diversification beyond just money markets and CDs, Jake can ensure his income keeps pace with inflation and lasts through even challenging investment environments over a 20 to 30 year retirement. Thanks for the awesome question. It's very important. As always, if you'd like to send in your questions, you can do so by emailing them to Poole Locke at poolelocke.com. All right, we'll move on to our second question. So we have an email from Stuart, and Stuart says, I've looked into long-term care insurance, but I personally think it's way too expensive. What is your opinion on it? All right, Stuart, you raise a very important retirement planning consideration regarding long-term care insurance. I can certainly understand the initial sticker shock at the premiums, as quality long-term care coverage does not come cheap. However, the underlying cost, it is designed to protect against are astronomical. Right? The reason long-term care insurance seems so expensive is because the potential long-term care costs it covers are themselves extremely expensive. Statistics show around 1 out of every 3 people will require some form of long-term care services during their lifetime. And for those that do, the average length of that care need is about 3 years. So let's put some numbers on that. If 3 years of full-time skilled nursing home care costs around $175,000 a year in your area, well, that's over $525,000 in costs, with a 33% chance of needing to incur, over $500,000 in long-term care expense. It becomes clear why insurers charge such hefty premiums to take on that risk. There is also a major kind of misconception that Medicare will cover long-term care costs. The reality is Medicare only covers the first 100 days of skilled nursing care, and even then with stringent qualifications. Anything beyond that 100 days comes fully out of pocket unless you have a separate long-term care insurance policy in place. So whether long-term care insurance makes sense, truly depends on your specific retirement financial situation. If you are just barely scraping by with enough, projected income to cover your basic retirement expenses, paying expensive long-term care premiums could make you underfund your retirement and unable to retire. In that scenario, you likely can't afford the coverage despite the risks. Now, on the other hand, if your retirement is very well funded with a healthy surplus projected, you may be able to, self-insure against long-term care expenses. Those with a significant overfunded status could, set aside a pool of assets intended to pay for potential long-term care costs out of pocket while still preserving their retirement income streams. This does not carry more risk, but can make sense for the, more affluent. For those in the middle who are modestly overfunded for their retirement income needs, long-term care insurance deserves very careful consideration. The premiums are burdensome, but potentially worthwhile to transfer that kind of cost risk to an insurer. Many in this situation opt for long-term care coverage despite the cost because they've worked so hard to build their nest egg. Paying for years of expensive long-term care out of pocket could severely derail their retirement plans. Hybrid policies that combine long-term care coverage with other components like annuities or life insurance are also growing in popularity. So these can provide additional leverage and features beyond traditional long-term care policies alone. Ultimately, comes down to analyzing your retirement financials and weighing your personal risk tolerance. For some, self-insuring makes sense. For others, transferring that risk provides invaluable peace of mind. But you're wise to carefully study this decision, and those potential long-term care costs can definitely impact your ability to invest for the sustainable retirement income you've worked so hard to achieve? Thanks for a fantastic question. As always, if you'd like to send in your questions, you can do so by emailing them to poollocke@poollocke.com. If you like what you heard, like and subscribe to our channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank,